Hello everyone, welcome to Brilliant Bankers. Today in this session we will be discussing about the treasury products and the nature of the treasury markets and the three types of market where a treasury of a bank deals with. That is namely the forex market, the money market and the securities market. So let's start with that of the forex market and its products. So products in the forex market. Before that, what is a foreign exchange? The foreign exchange market in India primarily involves in the trading of currencies. The participants in the forex market engage in various products and instruments to manage the currency related risks and opportunities. The forex market is the most liquid market as the free currencies can be readily bought and sold. Currencies that are not fully convertible, like that of the Indian rupee, have limited demand and are not actively traded, but enjoy high liquidity due to the size and the stage of the development in the domestic market. So, in the case of the Indian rupee, it is not fully convertible, but since the domestic market is a bit volatile, is totally volatile, there is a high chance of liquidity due to the size and the development in the market. The forex market is a transparent market, and other key products of the foreign exchange market in India are that there are spot transactions. These involve the immediate exchange of currencies at the current exchange rate. Spot transactions in the forex market settle on a spot that is typically within 2 business days, about which we will be discussing later in the same session. We will be also discussing about the forward contracts in the forex market, the future contracts, the swaps, the derivatives, and the trade finance instruments also. We will to give a basic idea about the ETF. It is the exchange traded funds. In India, investors also can gain exposure to the foreign currencies through the currency ETFs. Since it is a transparent market, these funds typically track the performance of a specific currency or a basket of currencies. Here, the information is disseminated in a very quick manner as it is everything is online and the liquidity is very high since the market is open 24/7. So what is a spot market? A spot market is a immediate exchange of financial instruments, primarily dealing in currencies at the current market price. So spot market is the immediate dealing of the currencies in a current market price. That is what we call the CMP. The settlement in spot. Other than that, we will go for a different type of settlements in the market. That is the cash and the ready, the term, the spot and forward. So what we have already gone through these in a previous video. So what is cash and ready? Whenever the settlement is done today, at the time of the transaction, it is called cash or ready. When it is done the next day of the transaction, it is called term. When it's done after 2 days after the trade, that is T+2, it is called the spot, and any time after that, it is called a forward transaction. So in the case of the spot, the transaction in spot are settled on the spot. That is usually within the time of 2 days. The participants buy or sell currencies at the prevailing exchange rate, reflecting the time and the market conditions. And the time of the market is always the 24 hours. Who are the main participants in this spot market? The major players of the spot market include the banks, financial institutions, corporations, and individual traders also who are seeking immediate currency conversion. There is a very high liquidity in the spot market, making it easy to buy or sell the currencies without the significant price impact on this. The most common uses of the spot market is that it is known for its high liquidity, making it easy to buy or sell currencies without significant price impact also. Coming to the common use, the businesses use the spot market for the international trade settlements, Travelers exchange the currencies, and investors also make quick currency transactions. It's a 24-hour market. Unlike stock markets, the spot forex market operates 24 hours a day, allowing continuous trading across different time zones in different countries. And there is also price transparency, that real time codes and price transparency contribute to the fair and efficient price discovery in the spot market. As we had discussed about the type of settlement, now let's go for the forward market. So, what is a forward market? It's a purchase or sale of any commodity or the currency on a future date. So, to define it, the forward market involves agreement between two parties to buy or sell an asset, that is, and for example, a currency at a specified future date and at a predetermined price. Treasuries may enter into a contract with the bank or a customers as their counterparties for the same the purchase or sales of a currency. Also, it may enter purely for the profit of purpose of profit making out of the price movements. The customized contracts. Forward contracts are always tailored to meet the specific need of the participants, allowing flexibility in terms of the contract size, the expiry dates, and also the other terms as mentioned in the contracts. The hedging of the risk, it is mainly used for hedging. Businesses often use these forward contracts to hedge against the future price movements, mitigating the impact on the currency fluctuations on the finance. So, what is hedging? Hedging is a way to protect yourself from a loss. If you are into stock market, you may be having a basic idea about the futures and options, wherein options are always a way to hedge for the price fluctuation in the futures. About hedging, we will go for a separate class. It's a vast area to deal with. So we will be discussing about in a separate session some other day. What is the standardization? Unlike the futures, as explained, the forward contracts are not standardized and are traded over the counter directly between two parties involved. But in the case of the futures, it is not between, it's not over the counter. It's always on a NSE or a BSE in a stock exchange. It is a what is a non-deliverable forwards? We can abbreviate it as NDFs. They are commonly used in currencies and have restrictions on convertibility or are not freely traded in the global market. Instead of physical delivery of the underlying asset, NDFs are normally settled in cash. The parties exchange the net cash difference based on the agreed upon notional amount and the currency's actual spot rate. It also helps in the emerging market currencies. NDFs are particularly popular for currencies in the emerging markets where regulatory constraints may limit their direct trading. Coming to the futures and options, they have the standardized contracts. Future contracts are standardized, as not in the case of the forward market. They are standardized agreements to buy or sell an asset at a future date and at a predetermined price, traded on a organized exchanges, which I mentioned as BSE and NSE. That is in the case of India. They have a liquidity and transparency, and with high liquidity and transparency due to the standardized contracts, making them attractive to the broad range of participants. Who are these participants? It can be any stock trader, it can be any bank, it can be any treasury, any financial institution, or a foreign direct investor. The margin requirements for future contracts typically require participants to deposit margin, providing the financial security and helping manage the counterparty risk that happens to the customer or the bank. The options, in this case, there's a flexibility by options provide the right, it's the right, but not an obligation. In the case of option, It is a right but not an obligation to buy or sell an asset at a predetermined price before or at expiration, offering the flexibility to the participants. So options are always used for hedging the futures. Normally, it is always said as futures and options, but traders take separate take them separately and also trade them separately as futures and options as options. But whenever you want to hedge something, you want to hedge your futures or hedge your stocks scripts that you have purchased in the stock market, you can use the futures and options for hedging your stocks. The call and the put options. Call options grant the right to buy, while the put options grant the right to sell. Traders use options for speculation, hedging, or income generation. Option buyers have a limited risk, while the sellers face potentially unlimited risk. This risk profile makes options versatile in the risk management also. Same ways, there is something called a swap in, in the market. So, what is a swap? These are the financial derivatives in which two parties agree to exchange cash flows or other financial instruments over a specific period. For example, swaps can be used for various purposes, including managing risk, altering the cash flow profiles, or gaining exposure to different markets. The spot and the forward transactions are primary product of the forex market. If in case there is a combination of both the spot and the forward transaction, or a combination of two forward transactions, in that condition it is called a swap. It is generally used for funding requirements with an profit opportunity with the interest rate arbitrage. So, what is an arbitrage again? Arbitrage is buying or selling of a particular commodity or a currency in two different markets. Buying it in NSE and selling it in BSE, or buying a currency in the Indian market and selling it in the US market at the same time. This is called arbitrage. This is also a way of gaining a profit opportunity. It also helps in the interest rate risk mechanism. One party exchanges a fixed interest rate for a floating rate with another party, where, because of which the application, the entities with differing views on the future movement of the interest rate can benefit from the interest rate swaps. In summary, swaps are the versatile financial instruments widely used in the global financial markets. They play a crucial role in the risk management and can be tailored to meet the specific needs of the market participants. But due to the complexity of the swap, requires careful consideration, and there are some associated risks, and the regulatory guidelines are to be complied with also. So the next topic is the investment of forex surpluses. What is a forex surplus? Any amount or any currency that is held as a surplus in a foreign currency after any trade is called forex surplus. This involves investing the excess foreign exchange reserves that is held in a treasury in various financial instruments to generate returns by a treasury. As in the case in India, the Reserve Bank manages India's foreign exchange reserves. These reserves are invested in diverse portfolio, including foreign government securities, sovereign bonds, and other liquid assets to optimize the returns while ensuring the safety and liquidity of the currency. Herein, for our banks, the treasury is responsible for the investment of forex surpluses, which arises from the profits of its operations, from the profit of the operations of its overseas branches, from the forex borrowings, from foreign currency or the convertible rupee deposits with the branches by the NRI customers. All these helps in the surpluses of the foreign exchange. Banks are also permitted to invest foreign exchange surpluses in the global money market on a short term or in a short term securities like that of the interbank loans, the short term investments, or in the nostro accounts. So, what is a interbank loan? Normally, not exceeding 1 year, but mostly in overnight deposits with the domestic and the global banks, wherein it is subjected to a pre-approved exposure limit to the banks as given by the RBI. What is a short-term investment? The banks are permitted to invest overseas in short-term instruments of high credit quality, such as the T-bills or the gilts issued by the foreign government. It can also be used to invest in the commercial paper and other debt instruments issued by the multilateral institutions subject to the appropriate policy for the investments if approved by the board of the bank. In the nostro accounts, where float funds of the banks are parked, the pending utilization or the customer draws are kept idle. The nostro accounts are the current accounts denominated in the foreign currency, which is maintained by the banks with the correspondent banks. So balances held in the nostro accounts do not earn any interest, of which, however, many correspondent banks offer automatic investment facilities for funds held overnight, subject to a minimum balance in the account. The correspondent bank automatically invests the excess funds in the money market on behalf of the account holding bank and pay in return the interest at a rate normally linked to the Fed rate, federal rate in case of the US currency fund. In all these conditions, the treasury gets a small profit. So the treasury is able to earn nominal interest on idle funds that is held in the nostro accounts, which is like that of a sweep facility that is being provided by maximum banks in India nowadays. So what is the rediscounting of the foreign bills? In the case of rediscounting, this is an interbank advance where the treasury refinances the foreign currency bills purchased or negotiated by the other bank. This is a kind of treasury product as the bills are rediscounted with the recourse to a bank. The bill rediscounting is generally priced higher than the money market placements as the advance covers a Hussein's period anywhere between the 15 to 360 days, and the counterparty would charge their customers the commercial rate of interest for the underlying of this product. It is an interbank exposure also, wherein RBI has allowed banks to include rediscounting of the bills in their credit portfolio. In an integrated treasury, foreign exchange fund management is not really a, different from the domestic fund management. As we can see, the products and markets overlap, providing a wide variety of the choices to the treasurer. So this is what we have discussed all about the foreign or the forex market products. Now we are moving into the money market product, which is also a part of the treasury product. So the money market product, it refers to raising and deploying short-term resources with a maturity of funds generally not exceeding more than that of a 1 year. The main three types of money market products are call money, notice money, and term money. The call money refers to any money or any placements that is overnight, that is for one night, that is taking a loan from a bank taking a loan from a bank for one evening, that is at the end of the day till the next day, that is called a call money. If any loan or if any borrowal is done for a period of 2 days to 14 days, it can be from RBI or any other bank, it's called notice money, And if the period is above 14 days but lesser than 1 year, then in that condition it is called as term money. The prudential limits for outstanding borrowing transactions in the call, notice, and term money markets can be said as, in the case of scheduled commercial banks, that is including a small finance bank, the call and notice money can be 100% of the capital funds on a daily average basis in a reporting fortnight, and 125% of capital funds on any given day. In the case of the term money for them, it is a internal board approval limit within the prudential limits for the interbank liabilities. The same goes to the cooperative banks, like the call, notice, and the term money. It can be 2% of the aggregate deposits as at the end of the previous financial year. In the case of the primary dealers or the PDs, the call and notice money, it can be 225% of the net owned fund as at the end of the previous financial year on a daily average basis in a reporting fortnight. And the term money can be also the same as 225% of the net owned fund as at the end of the previous financial year. So, what is a T bill or a treasury bill? It is issued by the government of India through the RBI, through the Reserve Bank of India. It is issued for a period of 91 days, 182 days, or 364 days. It's of three types. It is issued for a fixed period of 91 days, 182 days, and 364 days. All these tables are of a predetermined amount. The amount is always predetermined and it is fixed on that. It is normally issued on a fixed day, that is on the Wednesdays. Normally, the T bills are issued on Wednesday, and currently the 91 days T bill is issued weekly on in every week on each Wednesday. The 182 day T bill is issued fortnightly, once in every 15 days. Again, the Wednesday that is preceding the non-reporting Friday. And the 364 T bill is also issued fortnightly on Wednesdays, preceding the reporting Friday. So, counting it as Wednesdays. In every Wednesday, you have a 91-day T bill, and in every corresponding Wednesday, you either have a 182 days T bill or a 364 days T bill. The T bill, like all other government securities, is also in electronic form and is to be held in a SGL account. The SGL account is maintained by banks with the Reserve Bank and are also now permitted to operate through the SGL accounts to facilitate retail sales of the government securities. The secondary market settlement of the T bills also take place through the CCIL or the Clearing Corporation of India Limited. T bills being a negotiable instrument in character, mature for redemption on a previous day if the maturity date falls on a holiday. They are redeemed at par on the previous working day itself. So, what is a cash management bill? It is issued by the government of India in the consultation from the RBI. It is there since 2010. It is since 2010. Fine. We will be amending it later. It is there since 2010. The maturity period is 91 days, and the futures are the tenure or the amount notified, and the date of issue of the proposed CMB depends upon the temporary cash requirement of the government. However, the tenure of the proposed bill is less than always 91 days. The bills are issued at discount to the face value through auctions, as in the case of the T bills also. The announcement of the auction of the bill is made by the Reserve Bank of India through a separate press release issued 1 day prior of the date of auction. The settlement of the auction is done on a transaction or a trade plus 1 day basis. The non-competitive bidding scheme for treasury bills is not extended to the cash management bills, and the bills are tradable, and qualify for ready forward facility. That is, investment in the proposed bills is reckoned as an eligible investment in the government securities by the banks for the SLR purpose. So, what is a ready forward facility? It is accepting all these investments as a government security for the purpose of the SLR purpose in the banks. What is a commercial paper? A commercial paper issued by the corporates for a short term period, wherein a corporate wants to take some debt or a loan from the public. And the tenure for this is from 7 days to 1 year. The minimum period is 7 days and the maximum period is for 1 year. It is issued as per the guidelines of the RBI. The issuing company to have a minimum credit limit of A3 standards. They should have a minimum credit limit of the A3 standards. The minimum net worth of the corporate for issue of a commercial paper is 100 crore, and the minimum amount of investment in the commercial paper is rupees 5 lakh, and in a multiples of the same amount. So minimum amount that can be invested in a commercial paper is 5 lakh, or in a multiples of 5 lakh. It is issued in a demat format. It is having a very low credit risk as it is issued by the corporates and have a fairly active market. There is also a buyback scheme that is available wherein issuers can buy back the commercial paper issued by them to the investors before the maturity. And the buyback of the commercial paper shall be through the secondary market and at the prevailing market price of the commercial paper. The commercial paper, if it is being bought back before a minimum period of 30 days, it is not allowed, or it should not be bought back before 30 days from the date of issue. So, what is a certificate of deposit? It is same something like that of a commercial paper. Let's go to certificate of deposit. It is an certificate of deposit. It is an unsecured debt instrument similar to the commercial paper, but is issued by the banks or other eligible financial institutions. This is meant for high net worth individuals, and the minimum amount of investment in this is rupees 5 lakh, and it is always in a multiples of 5 lakh. The tenure for a certificate of deposit is a minimum period of 1 year to a maximum period of 3 years, and it is a negotiable instrument which can be transferred to any other person. This is mainly used by the banks to maintain the CRR and the SLR on the issue price of the certificate of deposits. Coming to the market repo. What is a market repo? It is used for the lending and borrowing of the money market funds. A market repurchase agreement is also commonly known as a market repo. A market repo is a financial transaction wherein one party sells a securities to another party with an agreement to repurchase the same security at a specified future date and at a predetermined price. It is essentially a short-term collateralized loan. The party selling the securities is the borrower, and the one who is buying them is the lender. That is how a market repo typically works. The borrower is the seller and the lender is the buyer. Wherein the borrower, the party in need of short term funds, sells his securities to the lender with an agreement to repurchase the same. And the lender, who is the buyer, he provides the funds agreeing to buy the same securities and lends money to the borrower in return. The lender earns interest on the cash that is provided by. It refers to the purchase of securities by the RBI with a commitment to resell it to it or at a pre-agreed price to the banks. Mutual funds and corporates are also permitted nowadays to participate in the repo market. It can be transacted in the central and the state security or that which are listed in the corporate bonds and debentures. There are two types of repos. It's a tri-party repo and a reverse repo. So what is a tri-party repo? It involves a tri-party agent to facilitate or a third person or a third party to facilitate the transaction and manage the collateral. What is a reverse repo? The lender initiates the transaction, selling securities to the borrower with an agreement to repurchase them. We learned that what is repo, lending, and borrowing money. But in the other case, it's sell, uh, selling the securities and agreeing to repurchase. Okay. So, what are the risks in the market? In this case, the risk management, the market repos are generally considered of very low risk due to the collateralization of the transaction. The risk primarily involves the potential decline in the value of the collateral. And the market repos are very crucial in providing the liquidity to the financial market. They also allow financial institutions to efficiently manage short term funding needs and optimize the use of their balance sheets. So, in all, we can say that the market repos are integral to the functioning of the market or the money market, providing a mechanism for short term borrowings and lendings. They are widely used by the financial institutions, including the central banks, the commercial banks, and also other market participants to manage their liquidity positions. Who are the other market participants? It is like the mutual funds and also the other corporates to manage their liquidity positions and optimize the investment portfolios. So we have discussed about the market repo and what is a securities market product. We have all discussed about the forex market and the money market. Now we are starting off with the securities market and its products. So initially, let's know what is a securities market. The securities market in India, it plays a crucial role in the country's financial system by providing a platform for the issuance, buying and selling of various financial instruments. It is being regulated by the SEBI or the Securities and the Exchange Board of India, which oversees the functioning of the stock exchanges, its intermediaries, and its participants. The participants in this securities market are the individuals, institutional investors, and foreign investors also who participate in the market to buy and sell the securities. So the investment business of the treasury is an important part of a integrated treasury and is composed of buying and selling products that are available in the securities market. Here, what are the types of securities that are traded in the securities market? They are the equities which represent the ownership of a company, which are traded as a stock, traded in a stock exchange, such as the National Stock Exchange and the Bombay Stock Exchange, the BSE and the NSE. There are also debt instruments, which include the GSECs or the government securities, the corporate bonds, and debentures, which are traded in the debt market. It also includes the derivatives, that is, the financial contracts whose value is derived from an underlying asset, such as that of the futures and options, which we have also gone through earlier in the forex market also. In mutual funds, investment vehicles that pool funds from multiple investors to invest in a diversified portfolio of stocks, bonds, and other securities. So, what are the main types of securities that are traded? Those are the G6, the corporate debt papers, debentures and bonds, the convertible bonds, and the equities. Let's go through them in detail. What is a GSEC or a government security? It's often the government security, which is often referred to as a GSEC, are debt instruments issued by the government of India to borrow money from the public. These are considered one of the safest form of investments since they are backed by the sovereign guarantee by the government. What are types of G6? It is a T-bill and a government bond. What is a T-bill? It's a treasury bill. These are short-term instruments with maturities up to 1 year, issued at a discount to the face value. The government bonds are medium to long-term debt instruments with fixed or floating interest rates and issued for maturities exceeding more than that of 1 year. These government securities are issued by the RBI on behalf of the government. The interest is paid always on the face value of these bonds. This is used for borrowing from the public to finance the fiscal deficit of the government, be it the state government or the central government. The primary investment is to comply with the statutory reserve requirements. So the banks use this as a primary investment to comply with its statutory reserve requirements, that are the CRR and the SLR. The maturity period of bonds in GSEC ranges from 1 to 40 years. So it is a very long period, or it can be taken as a short period also. So the government securities are given for a period of 1 year to 40 years, which is to establish the market determined yield curve. So the different type of G6 that are issued are T-bills and government bonds. And what are the main features of the government securities? It is risk-free as it is backed up by the government, and they are considered virtually risk-free. The interest payment, they pay periodic interest to the investment. Wherever there is a investment done, the periodic investment is being done. That is quarterly, half-yearly, or annual payment is being done. It is traded in the secondary market, which provides the liquidity to the investors also. What is a corporate debt paper? It is issued for a period of medium or long-term tradable bonds and debentures that are issued by the corporates and the financial institutions. We can define it as the corporate debt paper refers to a debt instrument issued by the companies to raise capital. These can take various forms such as the debentures, the bonds, and other debt securities. The different types of corporate debt papers are the debentures, bonds, and commercial papers. So automatically the commercial paper, which is given by a corporate bond, by a corporate, is on a requirement of some kind of fund. So they are taking debt from the public. These bonds and debentures are also a way of taking debt from the public. Wherein the debentures are unsecured on date, but it is never said as a unsecured paper. Debentures are always secured because it is taken on a particular or a stressed asset. Debt instruments backed by general creditworthiness of a issuing company. Bonds are similar to that of debentures, but it is given by a public sector company. It is referred to as a non-SLR security. Why? Because this is not included in a SLR or a CRR security. It is an attractive scheme because the yield is always higher than that of a government security. It is traded in a demat form also. So, what are debentures and bonds? These are also issued by the corporate bodies as discussed earlier in a corporate debt paper. Debentures and bonds are issued by corporate bodies on charge of specific assets. Long-term debt instruments issued by the corporations, typically secured and backed by the company's general credit. These are secured debt instruments issued by corporates in the private sector, and bonds are issued by public sector companies. So, what is a debenture? They are issued by private sector companies, and bonds are issued by public sector companies. In this case, both are secured, but debentures are governed by the company law and transferable only by registration. But bonds are negotiable instruments and is governed by the law of contract. There is also a thing that the debentures can be convertible or non-convertible. In the case of the bonds, it always encompassing various debt instruments that includes both secured and unsecured with different maturities and coupon rates. There are also different type of bonds, that is the convertible bonds, which is a mix of debt and equity, wherein convertible bonds can be defined as their type of debt security that can be converted into a specified number of shares of the issuing company's common stock. That is, on the maturity of the debenture, it can be converted into equity. That is the specialty of a convertible debenture or a convertible bond. The conversion option. Bondholders have the option to convert their bonds into the equity shares. Till that period, periodic interest is paid till the time of conversion, and it also provides investors with the opportunity to benefit from the company's stock price appreciation. So, on the date of purchase of the bond, it will be almost equal to the price of the or the share price of the company. But on the date of conversion, it can take the current market price of the company. So, what are equities? Equities represent the ownership in a company and are traded on the stock exchanges. In India, equities are commonly referred to as stocks or as shares, as we always say, the share market or the stock market, wherein shares and stocks are being traded. But the word to be specified is equities are being traded in a stock market. The investment is as per the exposure set up by the RBI. And what is the exposure for a banking company? The exposure should not be more than 30% of the company, that is the investing company, or the bank's own capital plus reserve, which is 30%. That is, the maximum limit should be the 30% of the company that the bank is going to invest on, or the 30% of the capital and reserve of the bank, whichever is lower. And these regulations are given in the BR Act. The share capital is of two types. That is, they have with voting rights shares and differential rights shares also. With the voting rights shares, each and every person has the right to vote. But in the case of a differential share, there are different things wherein you will be given preference on dividend and or voting and otherwise. You can either opt for the dividend payment or for a voting. So, what is a preference share capital? Is that capital which enjoys preferential rights with respect to the dividend payment at a fixed rate and the return of capital on the winding of the company. So, in the case of the preference share capital, whenever there is a winding up of the company, they are the persons who receive the share capital at the first instance, which can also be further classified as cumulative or non-cumulative shares, wherein the right to claim dividend does not lapse when there is no profit or inadequate profit and is carried forward to the next year. In the case is cumulative preference shares, while rights to claim dividend lapses in case of non-cumulative shares. In case of a cumulative share, if there is a loss in the company, the dividend will be carried forward to the next year. That is, even if there is a loss, a promised dividend is will be issued, but it will be carried forward to the next year. But in the case of a non-cumulative, it will not be carried forward to the next year. Redeemable or irredeemable share capital, which can be redeemed subject to the fulfillment of certain conditions that has been laid down under Section 50A of the Companies Act. The participating or the non-participating shares which have a right to participate in the surplus remaining after the payment of the equity capital in case of winding up of a company. There are also convertible and non-convertible shares which would be convertible into a exchange or exchange it with equity shares at a later date with or without the option of a preference shareholders. Equity trades are normally traded on stock exchange and the stock prices are influenced by the fundamentals of a company and are also various macroeconomic factors. So, in view of the risk involved in the equity trading, bank treasuries are generally cautious in investing the surplus funds in the stock exchange. So, automatically coming to the bank exposure, it should not be more than that of 30% of a company that it is going to acquire, or the 30% of its own capital plus reserve, whichever is lower, as mentioned in the BR Act. So we are coming to the end of this or today's session, and we have discussed about the type of treasury products and briefly about the different type of markets a treasury deals. If you have any questions, please feel free to leave them in the comment section below. Your feedback is invaluable and we are waiting for your feedbacks. Thank you. Have a great day. Do not forget to like, share, and subscribe our channel, The Brilliant Bankers. Until next time, this is Nishant signing off. Jai Hind.